Good morning and welcome to Real Estate Economics webinar series. I'm John Mulville, Vice President of Consulting here at Real Estate Economics, and I'll be leading this morning's discussion about construction cost trends and supply chain factors. We are going to look at the construction cost trends and the condition of the supply chain and see what insight that will give us into current market conditions and conditions for 2012. We're going to look at what factors are driving these trends. What's the current outlook for materials as they relate to residential construction? What condition, and we mean financial condition, and what's the state of their overall market as it relates to residential construction? And do these suppliers have any pricing power? What's their business outlook? And what will be their ability to support residential construction in the event of market changes in 2012? First, we'd like to frame this discussion with a look at U.S. home sales and the seasonality. Anyone who's worked in the sales department of any of the builders or in sales support recognizes how different buyers behave during the course of a year. Everyone has recognized that really the fourth quarter of the year has tended to be very slow. Buyers are also slow to get started in January of every year, but come the spring selling months, people get out and they start to look for homes and they try to acquire a home and get into that home sometime during the summer months so that they'll be there when school starts in August or September, depending on where you are in the country. Obviously, there's also weather-related issues. It's much more pleasant to go look for a home in the pretty spring months than be slogging through the snow of the winter months. But there's also factors related to construction. Most construction starts are highly seasonal in the U.S., and people like to go out and look when things are under construction. It's just much more appealing to look at a community that's being built than, a site where they say coming soon. But what you can see in our chart here is really the heavy months, March, April, May, June. We taper off throughout the summer, but what we're going to show today is that this seasonality spills over to almost every aspect of the industry, not just sales. It's going to go through the supply chain. It's going to go through materials cost, as we'll show you today. So what are the effects of this seasonality? We know that buyers come out in the springtime and disappear in the fall, but it's much deeper than that. Home builder stocks tend to follow these seasonal patterns very tightly with weak winter months and low stock prices. Builder stocks tend to rally through the winter months and through the spring months and peak out in the usually April, May, rarely June time period, then go back into hiding, trend lower through the summer months, trough out in the fall, and start this pattern all over again. Material stocks and supply chain stocks tend to follow this same pattern, as we'll show you today, even down to the Home Depots, the Lowe's, the Masco's, Vulcan Materials, and some of the other construction-related and materials-related companies tend to follow this same pattern, as we'll show you today. Let's start with lumber. One of the things, and we've talked about this in our previous webinars, we like to talk to sales agents. We like to see what the prices are. We like to see what the volume is. But that's really, just one part of the overall climate and how we can measure the climate. We like to look at lumber here. This is framing lumber from the Chicago Mercantile Exchange. This market will tend to move in advance of any improvement in the home builder market. Very, very quickly. It reacts, almost any time over the years when there's been an uptrend or a downtrend, and it doesn't take, a month of tracking, or you don't have to see what's gone in sales offices for 2 or 3 months. The people who trade these lumber contracts are very in tune with the industry. They're very in tune with what's happening in terms of supply, and they'll be all over these price trends. What we would usually see is right with the red arrow on the upper right-hand corner. We tend to see a little bit of move up into the fall and the winter months as people, speculators, traders, the commercial interests in these contracts tend to have lumber prices move up in the fall, just as the seasonality we mentioned before. Now look at the bottom of the current lumber contract. This is the 2012 lumber contract, March delivery as of Monday. I guess it would be Friday, January 20th. Look at the bottom of the table. We saw a huge spike in open interest this year. That's people holding contracts for future lumber delivery. We tend to see an increase in contracts in the fall. This year it's been a little bit bigger. Who owns these contracts? Well, usually it's commercial interests. If you're a lumber supplier, you're a Home Depot, you're a warehouser, or one of the private lumber providers, you usually own these contracts, but there's also broker owners, traders and brokers, speculators, if you will, who get involved in this to try to make money. And you can see there's been a tremendous run-up in the open interest this year. That's largely traders. Now, over time, their interest will shift. They will tend to be long or expecting lumber prices to go up in November, October, November, December. Then once the first of the year rolls by, they're going to change positions and gradually let these contracts roll off, close out their contracts, and generally they'll be out of this market by late spring. Let's look at the term structure on this lumber contract. And what we mean there is, what are the current prices and what are the prices going forward? The top red arrow is the current price. This is 110,000 board feet. If you're not familiar with the contract, it's really 2x4 framing lumber, $240.30 per 1,000 board feet. Current price, $240. Look at the year out price, $271.20. When lumber gets tight, supplies get tight, that front month, they call it, that current contract will tend to be more expensive than the future delivery contract. So this is telling us a couple of things. One, supplies are plentiful, because if supplies weren't plentiful, they'd bid up the near-term month. Also, it tells us it's difficult to maintain consistent exposure to this market, because when the March contract expires, you have to go out and buy the May contract. Well, gee, the May contract is more expensive by $17, so you're spending more money to maintain the same exposures. Most traders and hedgers don't want to have that exposure. They won't want to have that term structure where the out months are higher. That's not how they make money. They would vastly prefer to have higher prices up front, lower prices out back, so that they're not exposed to the cost of rolling their contracts. What does this tell us as it applies to home building? Well, that there's plenty of lumber out there, and that the lumber's market is really not seeing a big run up in demand or any sort of pressures that could be driving the prices higher. Now, the pressures, the lumber's sitting there growing all the time. It's on trees, but there can also be pressure coming from the mills and different parts of the supply chain that affect it. This contract is not showing anything like that. So let's look at some of the factors that have contributed to low lumber prices and the fact that you can get lumber readily and it's not really costing that much. If you look at the U.S. lumber market, it's almost entirely domestic controlled. It's controlled by conditions and factors that take place in the U.S. A lot of our lumber comes to Canada, but the Canadian housing market is quite small compared to ours, so it doesn't really drive that much in terms of price, although Canada provides a lot of lumber to the U.S. housing market when necessary. So the lumber market is really a good read on the U.S. housing market without that many outside influences that we have to worry about. There's not much noise coming from other parts of the world, if you will. One of the things we could talk to here is the Japanese earthquake. Not much lumber was required, not much U.S. lumber was required by the Japanese to get their earthquake rebuilding. Canadian supplies, as we note, are robust, almost to the point of causing trade friction. There's been some issues before the World Trade Authorities about dumping of various lumber products by the Canadians, although just in the past couple of days there's been a new lumber trade agreement signed by the U.S. and the Canadians. There's not much noise from the Chinese in terms of U.S. lumber. The Chinese tend to buy lumber in Southeast Asia. There's not much domestic production of lumber in China compared to the size of their needs, so they buy it in Southeast Asia where it tends to be cheap, and they also have a preference for lower cost grades. A lot of their construction isn't lumber like our conventional housing is. They do high rises and blocks and different sorts of things, so lumber is not always used in the construction of the house there. In South America, the lumber is abundant there, and the South Americans have found that they have the capacity to do their own engineered wood products, so they can do oriented strand boards and different subfloor systems that used to be made in America. But the bottom line of this is it means that the U.S. lumber contract is a great read and a great indicator to just look at periodically for the housing market in the U.S. So we talked earlier about seasonality and how that comes into play and how that affects housing stocks, how that plays into the stock prices of all these companies. So I've gone back and looked at a couple different years. Here's a domestic lumber supplier, Weyerhaeuser. Of course, they have a home construction business, but we'll just be talking to the lumber aspects of that today. Here's the last 4 years shown in the red arrows. The stock for this particular company has tended to peak every spring, right in line with seasonality. Then it runs down, sort of troughs out in the summer, comes back up every spring. So this is a pattern that's repeated itself year after year after year as it relates to a domestic lumber supplier. We'll look at a couple of other things here. This chart shows the symbol CUT, that's C-U-T. This is a lumber exchange traded fund. Pays a relatively decent dividend, by the way. Hasn't been too bad of an investment, especially if you're on top of the seasonality. You can see here what's gone on in this particular ETF through a housing market recession. We've still had the same peaks in the April, May, June period. This one has a little later cyclicality than some of the other ones, and then troughing and downtrends through the rest of the year. But still, the seasonal patterns are observable here. And it looks like the pattern for 2012 is just getting started. Along the same lines, a lumber-focused real estate investment trust. Now this has a different tax structure than a conventional equity. These guys are paying out a large portion of their earnings in the form of dividends. This thing also has a nice dividend. This has a little longer chart on it, but you can see here again, good seasonal strength in about June of each year, trailing off the rest of the year, following the pattern of sales that we see among the home builders and the people coming into sales offices. So now that we've looked at lumber and seen what sort of effect and what sort of cyclicality, seasonality it experiences, let's talk a little bit about suppliers, the supply chain, who's out there supplying home builders and what their experiences are. We've been hearing that many subcontractors have really been on survival mode the last few years, and they're building practically at no margin. We call it survival margin. Essentially, they're paying the G&A and keeping the doors open and not doing much more. Some of these trades have seen a big drawdown in the number of people that are active. There's huge groups of subcontractor pools that have not been able to make any money and have not been able to stay on. We think that if the economy rebounded, that there could be temporary shortfalls in the ability to meet some of these functions, although the skilled people are still out there and would probably come back to the market quickly if profits were up a bit. So we think if they had the opportunity, let's just take framers for example, they would probably improve their bids, or increase their prices a little bit so that they weren't offering, or operating on a survival mode. And would try to get prices up a bit, but we doubt prices are really going to run away here. Most of them have been, trying to keep doors open. They'd like to have more market share. They'd like to have more business, but we think that the competition is pretty abundant, and after a quick price rise where they could again have enough to live on, that prices would tend to steady out. We really don't see much pressure that was going to cause any sort of runaway cost inflation in labor, in part because there's high unemployment in this country. But also we think, with a little bit higher price, people would be happy and they'd be more focused on rebuilding market share and taking market share, maybe even some consolidation eventually. But initially, return to profitability and try to stake a claim in the market. So what have the builders been telling us when we ask them about materials costs and subcontractor costs, supply chain costs? Well, these are almost perfect quotes from some work we've been doing. We've been bidding more work to subs lately. to more subs lately to get the best price. Some people, in search of better price, are broadening out their quoting patterns. Other people have been narrowing the list. They've had a big list, and instead of going out to the same group, they're narrowing, trying to get a little bit more critical mass with certain low-cost providers. Really, at the end of the day, they're trying to achieve a greater cost effectiveness. They're using different approaches to get there, but it's the same goal. We're bidding more, we're bidding less, whatever it is. The goal is to reduce the construction cost to the extent that we can, and still maintain, a decent relationship with suppliers and a decent number of people that we can go out to in case demand does improve. In terms of suppliers, let's look at Louisiana Pacific. Many of you are familiar with them. They're a manufacturer of engineered wood products, oriented strand boards, subfloor systems, different engineered materials that are very common in housing construction. They show the same seasonal pattern here that we've seen with sales and with the home builders. Big surges in the April, May, June. The rest of the year is not quite as good. So even during this housing recession, we've shown the same pattern in a couple different industries, recurring year to year to year. More and more, some of this engineered wood stuff is being made in Brazil. Even Louisiana Pacific has a presence there, plus there's domestic suppliers in Argentina, Chile, some of those places. The Chinese have really improved their capacity here. So as much as this manufacture of these goods has gone around the world, we still like to look at this and see what it will tell us about the U.S. and the domestic economy. Another one, we've got a little longer time horizon on this, just so that you can see that this pattern recurs. The seasonal pattern we've talked about, even during a severe disruption going back to 2007 in this particular table chart. U.S. gypsum drywall manufacturer has seen the seasonal peaks occur late in spring, April, May, June quarter. The rest of the year, this trades off, consolidates. People come into it in the fall, leave it in the spring. Very recurring pattern. So really, what does that mean? Let's carry this over to the full-scale housing industry. This is the XHB. It's the S&P Home Builders ETF, traded every day. In the stock market, you can buy this as a surrogate for, it's almost an index of home builders. You can see again, we've got our same seasonal patterns in play year after year after year here. Very poor results in the fall. These stocks rally through December, through January, frequently into April, May, June. Let's come to the right and look at this year. We had a deep, deep low back in, I believe it was about the early December period that coincided with the European debt crisis. It looked like the European debt crisis was going to lead to a much more severe worldwide recession, and so the home builder stocks, anticipating that weakness, sold off all the way down almost into the 12 even level. That's the price in the green on the far right, and now this has come all the way back to 1857. That's a 52% rebound in this index on a seasonal basis, because if you've been out there, we've got a little bit of improvement in home sales, a little bit of improvement in the resale market, some drawdown in inventories, but nowhere near the 52% rebound that's gone into the housing stocks. So, we can't say for sure at this point in time that this doesn't continue, but it seems like we've got a recurring phenomenon here. It comes through every year. Maybe this year it'll carry a little farther, but we don't see the trajectory of job growth and housing sales improving so dramatically that this year would be fundamentally different than the last 2 or 3 or 4 years pattern might suggest. So really, what's the bottom line? Europe looks like it's in a recession. The Asian economies have strong growth by our standards, but it's come down from double digits into the 6, 7, 8%. So overall, the global economy is a little bit too weak to drive any big increases in construction materials. In 2009 and 2010, if you recall, we had a surge in commodities prices. Copper was way up, oil was way up, grains, some of the soft commodities went way up. That led to a lot of money flowing into those areas. There was new research, development of new mines for copper. A lot more, the supply chain was added. People put a lot of money into commodities. So now there are more suppliers and sources for some of these things than we've ever seen before. That suggests we will not have runaway inflation in most of these things, and that costs ought to be under control for at least the next several years. Third world countries have become better suppliers of some of these things. You could really see that in the Thailand floods this year, when a number of hard drive factories were underwater, literally, and how third world countries have taken on a role in the manufacture of complex products. Well, that extends into the housing market. They can build a lot of things there that used to be the domain of more advanced countries. Some of these manufacturing facilities have become very, very advanced, moving to these countries for their low wages, but still providing increasingly complicated manufactured goods. As we look forward, we can expect inflation to increase over time. I think, if you're an American consumer, we've got a lot of things going up and a lot of things going down, but serious inflation that really affects everybody tends to lag quantitative easing and money printing by several years, often 3, 4, 5 years. And so we may be on the verge of a QE3 here. That would suggest to us that serious inflation might be 3, 4, 5 years out. It'll really come home to roost when all these policies and all this easing is over and it's time to unwind the Fed's balance sheet. That money has to find a private outlet someplace, or it will find its way into the supply chain, causing severe inflation. But it's going to take time. So it's our view that the year-to-date run-up in housing and material stocks is a seasonal repeat of the seasonal phenomenon. We've seen this before. Unless something dramatically changes, we don't think 52% is a nice return on those housing stocks. We'll see what it looks like in a month, if they're 2 months or 3 months, see what sort of changes really transpired. But in our view, costs are relatively contained. The supply chain looks good. Suppliers are well positioned. We might get some sort of good bounce in costs initially, but it's unlikely to run very far. We think these suppliers will want to rebuild their market share. Market share will be everything. Coming out of a recession, if we get any severe growth, they will really be driving costs down to build their clientele back. And so that tells us that the cost side of the business is largely under control. A quick plug, we've got a upcoming webinar series covering Northern California, scheduled for each Wednesday during the month of February. This is a paid series. These 1-hour series include the PowerPoint. Many of you have seen these before. We'll look at employment, we'll look at price trends, we'll look at appreciation, go into tremendous depth in these areas. So here's the contact information. Go to www.realestateeconomics.com. You can see the schedule for that, and you can register in advance if you're interested in that sort of thing. I'm John Mulville, Vice President here at Real Estate Economics. Call me if you have any questions about what we've presented today, or anything, topic of interest that you'd like to share with us. Some of our feedback on these things just gives us tremendous insight into what's happening on the ground in some of these areas. We hope you found this insight and our research interesting, and you can put it to use in your daily careers and work. Thank you for joining us today, and please join us for our February series on Northern California.